$70. Remember that number. Because right now, as we speak, 6 massive, independent financial forces are screaming towards that single price point. Intense. On Monday morning, when the opening bell rings, $70 won't just be a price on a screen. It will be a battlefield. It is the level that will either trigger the most violent upside breakout we've seen since the January rally to $121, or it will become the most devastating bull trap since the crash of 2025. The mainstream media is talking about market fluctuations. They are wrong. This isn't a fluctuation. It's a systemic convergence. Serious. Every piece of data, from the vaults of the COMEX to the industrial hubs of Shanghai, is pointing to the same 48-hour window. Tonight, on Market Crux, we are going beyond the charts. I am going to show you the 6 measurable forces that are converging on $70. I'm going to show you why the banks are terrified of Monday's open and why the physical silver market has already divorced itself from the paper price. If you have a single ounce of silver or if you're thinking about entering this market, you cannot afford to skip a single second of this briefing. This is Market Crux. Let's look at the data. Let's start with the most basic yet most powerful force: psychology. In commodity markets, round numbers like $70 aren't arbitrary. They are concentrators. Since silver broke below 70 on March 25th, it triggered a cascade of algorithmic selling that pushed us to a 2026 low of $60. But look at what happened next. Silver didn't stay down. It bounced $10 in a matter of days and is now pressing against 70 from below. Think of $70 as a mechanical dam. Above this level, you have a massive cluster of buy-stop orders from traders who are short. Below it, you have sell orders from institutions trying to keep the lid on. Silver has tested this $70 level 4 times since Thursday. Here is the crux. Each rejection is getting weaker. The selling pressure is evaporating, while the buying pressure is intensifying. When a dam is hit 4 times and doesn't break, it doesn't get stronger. It gets structural fatigue. On Monday, that dam is ready to burst. Force number 2 is pure mathematics. The 50-day exponential moving average, or EMA, currently sits exactly at $69.50 to $70. In 2026, humans don't move the markets. Quantitative algorithms do. These systems represent nearly 60% of all futures volume, and their primary on-off switch is the 50-day EMA. Below the 50-day, the machines are programmed to sell or stay flat. Above the 50-day, they flip to aggressive buy. Silver has been trapped below this line since the March breakdown. Every trend-following bot in the world is currently bearish. But the moment we close above 70 on Monday, every single one of those systems will flip simultaneously. We are talking about a surge of buying volume that could push the price up $3 to $5 in a single trading session. This isn't speculation. This is how the code is written. While the bots wait for the price, the smart money is looking at the commitment of traders, or COT report. Right now, speculative long positions have collapsed to a 13-year low. Managed money is sitting on the sidelines with their hands in their pockets. They were washed out during the drop to $60. Why is this good? Because it means the market is dry. There are no weak hands left to sell, but there is a massive amount of sideline capital waiting for a reason to jump back in. The last time we saw a COT trough this deep was in December 2025, just before the rally from 33 to 121 began. The fuel tank is full. All we need is the $70 spark. This is where it gets dangerous for the banking sector. Force number 4 is the 349 million ounce trap. The commercial banks, the big players, are currently holding a concentrated short position of 349 million ounces. To put that in perspective, that is nearly 5 times the amount of deliverable silver currently sitting in the COMEX vaults. At $69.57, these banks are underwater on almost every short position they've opened this month. If 70 breaks and the algorithms flip long, these banks face a death spiral. They have 2 choices: either absorb billions in losses as the price rockets, or panic buy silver to cover their shorts, which adds more fuel to the fire and pushes the price even higher. In January, this exact feedback loop took us from 33 to 121. Today, the short position is even larger. The spring is wound tighter than it has ever been in human history. Force number 5 is the April 1st notice day. While the paper market fights at 70, the physical market is facing a liquidity crisis. Tuesday is April 1st notice day. Currently, over 1,700 contracts are standing for delivery. That represents 8.6 million ounces of physical silver that must be produced. But look at the COMEX vaults. Registered inventory, the stuff that is actually available for sale, has drained to 76 million ounces, and it's bleeding at a rate of 2.5 million ounces per day. The coverage ratio is now at a critical 13.4%. If even a fraction of those contract holders demand physical delivery instead of a cash settlement, the COMEX defaults. The shorts know this. They have until Monday night to either find the metal or buy back their paper contracts. This is why the volume at 70 is going to be explosive. The final force, and perhaps the most ignored, is the east-west fracture. In Shanghai, silver isn't trading at $70. It's trading at the equivalent of $89 per ounce. That is a $19 to $20 gap between the East and the West. China has already classified silver as a strategic material, similar to rare earths, and has restricted exports. This means the arbitrage, the process of buying cheap in New York and selling high in Shanghai, is physically blocked. The only way this gap closes is for the New York price to rise. Shanghai is acting like a gravitational well, pulling the COMEX price upward. When Shanghai opens tonight, 12 hours before New York, we will see if the gap widens. If Shanghai rallies even 2%, the pressure on the $70 level in New York will become unbearable. Beyond these six forces, we have to look at the structural deficit. 2026 is the sixth consecutive year where we have used more silver than we have mined. The deficit is now over 820 million ounces. AI data centers are using 15% more silver than projected for high-speed conductors. Solar PV is now 29% of total industrial demand. Even in regions like Turkey, as we discussed with gold, while they dump assets for liquidity, industrial silver demand is still rising. Physical premiums are telling the truth. While the paper price says 69, the real-world price for silver eagles and generic bars is already between $82 and $87. The paper market is a lie. The physical market is the reality. Finally, let's connect this to the April 6th deadline. While the $70 convergence happens on Monday and Tuesday, the background noise of the Middle East conflict is the multiplier. Iran has rejected the ceasefire. Trump's deadline is 7 days away. History shows that in times of war, silver's safe haven status is amplified by its industrial necessity. If a strike occurs, the 100-level dollar index won't matter. Silver will decouple from the dollar and move solely on supply chain fear. $70 will look like a bargain in the rearview mirror. We are at the end of the line. The 50-day EMA, the 349 million ounce short trap, the Shanghai Gap, and the April delivery deadline, all of it is landing on $70 at the exact same time. Convergence zones like this don't resolve with a whisper, they resolve with a sonic boom. If we break 70 and hold, the next stop is $74, which is the Fibonacci 0.382 retracement, and then a clear run to 82. If we fail, the $60 floor will be tested again. But with a 13.4% coverage ratio and an $89 Shanghai price, the odds are heavily skewed to the upside. The paper is burning, the vaults are empty, and the countdown is at 0. I'm going to be very clear. Monday morning is not the time for wait and see. This is the time for data. If you are watching this, you are already ahead of 99% of the retail market who is still listening to the Goldman Sachs sell recommendations. They want your silver. They need your silver to cover their 349 million ounce hole. Don't give it to them. I will be live the moment Shanghai opens tonight to track the arbitrage gap tick by tick. If that $20 gap starts to move, I'm sending an emergency alert to this channel. Step 1. Hit that like button. Let's get this data to everyone holding physical metal. Step 2. Subscribe and turn on the bell. In a market moving this fast, a 2-hour delay in information is the difference between profit and a trap. $70, that's the number. Everything else is just noise. Market Crux, signing off.